So this is kind of what we're looking at in terms of what we're talking about asset financing, the financing of solar projects. And then kind of what the picture is going to look like in the coming years. You're basically going to see a market, a U.S. solar market, which probably now it kind of looks like a relatively kind of conservative view. By 2020, we'll reach 30 gigawatts, and that's going to kind of call for major capital requirements. And that's kind of what this talk is going to be about, is kind of how we get to those capital requirements. And I want to say to conclude, because I'm about halfway through the talk. And so I want to kind of talk about what it is, and we kind of talk about what a solar project is and what the business model looks like. This is basically kind of the most simple model. This is kind of like a utility scale PPA model. You have a project, signs an agreement with the utility, and the project is funded by a combination of equity from a developer, debt from a lender, and then what's known as tax equity. And maybe that term is familiar to many of you and unfamiliar to some. It's kind of like the very unique incentive that exists in the U.S., which is basically you get an incentive that comes in the form of a tax credit. So you wanted an investor who can capture that tax credit. So that's your tax equity investor. This is a very simple model. And then another simple model is kind of a host-owned model, something like what a homeowner would have potentially. You're the host. Maybe if you have excess electricity, that's kind of going to the utility, and then you basically have an installer that's kind of come in and kind of install the project. These are relatively simple models. What's exciting is kind of the evolution that we're starting to see, which is starting kind of aiming towards what's called kind of a third-party finance model. And here you have kind of what's known as the vertical model, where you basically have, and this has been popularized by an entity like Solar City, say. So Solar City basically kind of sets up a special purpose vehicle, gets tax equity and debt into that SPV, and then that special purpose vehicle kind of creates a project portfolio, and then you have multiple hosts. And so you're not actually providing your own financing as if the asset is sitting on your roof, you're not actually providing the financing. There's a separate third-party financier who's behind it, who might even own it, and you're just leasing it from them. And then there's variations on this model. This is what we call the vertical model. You might have something like the semi-vertical model, where you basically kind of end up disaggregating the installer from the financier. And there's many more variations to talk about this. But what's interesting about these models is that all of a sudden it kind of opens up solar development to a whole new range of financiers who want to participate in the financing of many projects, of many distributed projects. You don't need to just be a homeowner. You can be kind of a financier supporting the growth of residential and commercial solar. And so now I want to kind of get to what I think is like the climax of this discussion, which is what we see in terms of what solar financing looks like today and what solar financing is going to look like tomorrow. So here's the picture today. You basically have three stages of solar development. You have the development of the project, construction, and the commissioning of the project. And then you have three sources of funding. You have debt, you have equity, and you have tax equity. Again, this is a very American picture. This doesn't exist anywhere else in the world. It's the tax equity dimension that makes things interesting. And right now, you basically have the banks who are providing the long-term debt. And you also have the banks basically being the tax equity investors, because they're the ones who know that they have tax appetite and they're kind of sophisticated enough to know how to deal with tax equity. So far, so good? You might also have, you potentially also have equity from developers and from utilities, and you might even have the case of utilities themselves being the tax equity providers. This is relatively unique. I was actually just talking to Andrew, who works with some of the co-ops, and I just learned that the co-ops themselves might actually be tax equity investors, specific types of co-ops. Is that right?
Yeah, there's certain situations where they might have a tax appetite and might be able to leverage some sort of third-party financing vehicle, but there's also a cultural issue there, and it's certainly not ubiquitous.
Not ubiquitous, yeah. Good characterization. Not at all kind of common for utilities to be the tax equity providers. And then who else could be the sources of equity? You could just be a small, medium-sized developer. It could be kind of infrastructure private equity firm, venture capital, obviously. There's all kind of very expensive equity, bear in mind. And then you have the insurance companies, which, depending which insurance company you talk to, they can basically kind of span all these areas. And this is kind of very natural fit for insurance companies who are looking for long-term assets to finance. And they can be providing debt, they can be providing tax equity. We've even heard of European insurance companies that like to provide all the equity. So that was the picture for today, and this is what's going to make the talk interesting, is that we're starting to see an evolution. And so this is the picture going to look like for tomorrow, potentially, where you're still going to have the stages of development, construction, and commissioning, but now you have kind of this extra stage, which at the end, you kind of spin out the operating asset. You spin out the operating asset. Now, who's going to be providing the funding? The banks, but look at what the banks kind of should be doing. Banks should not be in the business of providing long-term debt. That's not the business model for banks. The business model for banks is providing short-term debt, short-term borrowing, corresponding with short-term borrowing. You could, again, have the banks providing tax equity, but you could also have non-financial corporates being the tax equity investors, corporates like Google, which has already entered the game. There's many other companies that could potentially enter. Chevron will have kind of its first forays this year. Again, you have the same players potentially being the equity sponsors, but look at the kind of the reduced role for venture capital, which is a very expensive source of equity. And so all of this is what all of this is kind of driving at is how do you kind of reduce the very expensive equity. I think the panel will start to get to some of these topics as well. And now you start to see kind of the emergence of potentially some new types of players, like high-risk hedge funds being the sources of equity, or in terms of the long-term debt, the infrastructure debt funds having an increased role. And we're already starting to see the infrastructure debt funds have a more prominent role in Europe. Again, infrastructure private equity being some of the equity providers, you could have the utilities themselves who recognize that solar presents like a major threat to their business, become kind of more acquisition-oriented, and so they become the owners on a long-term basis, the equity owners of the assets. And again, you have the insurance companies. Now here's where things get interesting, is you start introducing what we call these high liquidity investment vehicles. This is what everyone in the industry is talking about. This is the hottest topic in US solar right now. It's not about the Chinese tariffs, it's not about modules. This is the hottest topic to talk about, is what are all these vehicles going to look like? What's financing going to look like in the future, and how do you basically increase liquidity? You'll hear various kind of things brought up. You hear about kind of project bonds. You hear about asset-backed securitization, the same way that the mortgage loans have been secured, the way mortgages have been securitized, or student loans, or even kind of taxi medallions or hamburger sales. It's only a matter of time before solar leases themselves get securitized. When I say a matter of time, I mean this year, and potentially something could have already happened depending on your interpretation of some news from Credit Suisse and Citi 2 days ago. You could see the emergence of master limited partnerships. My view is that these are getting kind of much more buzz than they deserve, but it's kind of that's what everyone's talking about. You could see the real estate investment trust vehicle being turned into a solar real estate investment trust, and DOE itself has been writing about whether this is kind of a potentially kind of viable legal play. And what I think is potentially the most interesting, which gets talked about very little, but I think it's all about this, is yield companies. What I mean by yield companies is the idea of taking assets themselves, and basically kind of floating them into the public market. And it's actually very kind of commonly done in Canada, on the Toronto Exchange, for example. There was trusts set up in the past that kind of made this possible, but it's only a matter of time before we see that in the US, where you basically kind of see an aggregation of assets being pulled together and floated in the public market, and essentially kind of being dividend-yielding assets. And what is the implications of all of this? The implications has to do with the kind of the new types of investors that could come in. These investors will not come in unless these vehicles are available. But the day you make these high liquidity vehicles available, that's when you get the $100 trillion of wealth that's out there globally tapping into solar investment. What does it do to cost of capital? This is what cost of capital looks like today for US solar. On the development side, you're talking about greater than 20% cost of equity. That's what the venture capital is a very expensive source of equity. Once you're kind of getting to development stages, you're looking at maybe kind of 15% cost of equity on a levered basis. That's what private equity firms will tell you. In terms of tax equity, you're looking at 7 to 9% tax equity yields on an unlevered basis. And then kind of once you have the project actually on the ground, you may be talking about 6 to 7% cost of debt. And you're still basically at 14% cost of equity because it's still private equity owning the assets. What's going to look like in the future? You're still going to have kind of very expensive equity to just get the early stage project going. But here's where things get interesting. Potentially you have lower tax equity cost if more players start getting tax equity gain. Potentially lower cost of debt if you start looking at something like the bond markets. And then things get really interesting, which is that the day you kind of go into yield company structures or MLP structures or REIT structures, you're talking about 6% cost of equity. This is the aspiration. This is what everyone's talking about. The cost of developing solar aren't going to change. They're still going to be very expensive on an equity side. But it's the fact that it's such a safe investment, it shouldn't be a 14% equity return investment. Do you want me to pause here, Peter, or should I?
Does anyone have any questions? There is going to be a quiz, so.
I have a couple more thoughts to share, but it depends on the patience of people.
The timing of the orange?
What's that? It's vaguely tomorrow. Unclear. some kind of public announcement of securitizations. I don't think MLPs are going anywhere. I think the REIT structure, there's people kind of very quietly working on them very hard, but that might kind of come out around next year. Yield companies, next 2 or 3 years or so. I mean, there's some banks that have been working with that. Yeah, Kevin.
Are all the IRS issues worked out on Orange yet, or is that still?
What's worked out in Orange on the IRS side? The REIT structure, I mean, do you know, I mean, it kind of, whether the REIT structure is kind of, what the DOE's kind of latest read on whether the REIT structure requires legislative change or not?
So, we don't think it requires legislative changes, but it will require a letter issuance by Treasury.
Okay, so,
Repeat that.
yeah, so what I was asking, this has actually been up in the air, whether the REIT structure actually requires legislative change to be made viable. What Min basically